Welcome to Talk Tickers, your deep dive into the latest earnings call releases. We cut through the noise, synthesizing the hard numbers and, the strategic narrative.
So you can get straight to the substance that really drives investor decisions.
Exactly. Today, we're peeling back the layers on the Q3 2025 earnings call for Modiv Industrial Inc. That's ticker MDV.
Right. A fascinating small-cap net lease industrial REIT. And our mission here is to really dissect the trade-offs this management team is making.
It seems to be a story of prioritizing balance sheet durability over, say, raw growth speed.
It is. And we want to understand the internal catalysts that matter most for you, the experienced investor who might be watching this high-yielding name.
Okay, so let's get straight into the results snapshot. The market reaction was kind of muted, right? A little negative even.
It was, because on the surface, the headlines presented a bit of a mixed financial picture. But management's take was, I thought, very telling.
They called it boring but profitable.
Boring but profitable. That tells you exactly where their focus is right now. And it's on cash flow.
So let's talk about that cash flow. The core metric for a REIT is adjusted funds from operations, or AFFO. How did they do there?
They did very well. Modiv delivered 36 cents per diluted share for the quarter, and that wasn't just a small beat.
It was a pretty big jump year over year.
A huge jump, 22%, and it comfortably surpassed the consensus analyst estimate of 34 cents. Management was quick to point out it beat all 5 analyst estimates.
A 22% year-over-year increase in your most critical cash flow metric is, well, it's significant, especially now. But we do have to talk about the things that tempered that reaction.
Exactly, because the GAAP numbers were softer. Revenue came in just slightly below consensus, $11.7 million against an $11.7 million expectation.
A tiny miss, but a miss nonetheless.
In GAAP EPS, the traditional accounting profit number was flat. 0 cents per diluted share. That missed the 1 cent consensus.
Okay, so for investors who might get hung up on that, why should we put less weight on that zero GAAP number and focus almost entirely on the AFFO beat?
It's a great question. Because for a REIT, GAAP EPS is just a distorted number. It gets hit with these massive non-cash charges, mainly depreciation.
Right, which is an accounting rule, not actual cash leaving the business.
Precisely.
Yeah.
AFFO strips all that out. It's the purest proxy for the actual distributable cash flow. And that's what pays the dividend. So the AFFO beat confirms the core business is generating durable, increasing cash.
That clarity is essential. But there was one little detail in that AFFO number we need to flag, wasn't there?
We do. The result was partially boosted by a non-recurring $300,000 easement termination fee.
A one-timer.
A total one-timer. And management was very clear on the call. Do not factor this into your forward projections. It's not happening again.
Okay, so let's unpack this operational resilience, because the management commentary on the call was incredibly candid. The CEO described their execution as gritty and grindy.
It did. But the quote that really defined the whole call for me was his description of the company as, what was it?
A goddamn cockroach that could survive a nuclear war.
Yes. And that phrase speaks volumes. I mean, you have to remember their history. Modiv came public just weeks before the Fed started aggressively hiking rates.
So their entire public life has been in this hostile, rising rate environment.
Their entire public life. That cockroach mentality is about survival. It's about defensive positioning, making sure the balance sheet is a fortress, and not chasing growth with expensive capital that could kill you later.
And the balance sheet really does back that up. They have 100% fixed rate debt,
which is just a massive competitive advantage right now. Their weighted average cost on that debt is a staggeringly low 4.27%.
Wow. When competitors are maybe refinancing at 6-7%?
Exactly. And critically, they have no debt maturities until January 2027. That gives them a really long runway without refinancing risk breathing down their neck.
So that structural integrity lets them focus on their main growth lever for the near term, which seems to be this asset recycling plan.
It's all internal value creation. They're essentially manufacturing their own growth. The plan is to systematically rotate roughly $150 million worth of assets.
And what's the arbitrage they're trying to capture here? What's the spread?
It's all about that yield spread. The plan is to sell lower yielding properties. We're talking assets in the low 6% cap rate range, and then immediately redeploy that cash into higher yielding industrial deals.
And they're targeting?
They're targeting what they call mainly 7 handles, so mid to high 7% cap rates. That 100 to 150 basis point spread translates directly into non-dilutive AFFO growth.
It sounds powerful, but they kept emphasizing systematic and deliberate. If they have $150 million to rotate, why not just get it done?
And this is one of the most crucial constraints that you have to understand with small cap REITs. It's a tax constraint.
The IRS?
The IRS. They are limited to a maximum of about 7 individual asset sales per year.
Only 7. Why such a hard gap?
Because if they do too many sales, the IRS could reclassify them as a dealer or trader, which would revoke their REIT status. And that would be catastrophic.
How so?
All those profits from the sales would instantly be taxed as ordinary income instead of the much more favorable capital gains. It kills the entire efficiency of the recycling strategy. So it forces them to be incredibly deliberate.
That's a fascinating detail. So with that in mind, are they actually finding deals that hit those 7-handle cap rates in this market?
Management said the market was choppy. It slowed down in late summer. But activity has picked up recently. Crucially, though, they said they are tightening their buy box.
Meaning they're being more selective.
Extremely.
Well,
Only transacting when the cap rates clearly exceed their cost of capital. Again, that's the cockroach mentality. Discipline first, growth second.
let's talk about the quality of the portfolio itself.
Yeah.
What are the key metrics that support this durable revenue base they keep talking about?
Well, the portfolio shows really excellent long-term visibility. Their weighted average lease term, or WALT, is at an impressive 14.2 years.
So long-term certainty on that rent.
Fantastic certainty. And about 28% of their rent comes from investment-grade tenants. Plus, they have embedded rent escalators of about 2.5% annually, which guarantees that internal growth.
It sounds remarkably stable. So where is the operational pain coming from right now? What's the big drag on cash flow?
That brings us to the elephant in the room. The delayed sale of that former Costco/KB home property. This thing is vacant and it is actively bleeding cash.
How much are we talking?
It's an operational drag of approximately $40,000 per month.
$40,000 a month. That's a direct substantial hit to AFFO.
It is. The closing got pushed out again. Now it's targeted for December 15th with a final extension maybe into February. Eliminating that $40,000 monthly bleed is probably the single biggest, most immediate internal catalyst they have.
It's quantifiable and its removal is an instant boost. What about the other problem assets they're trying to get rid of?
Well, they formally engage a broker for the Calor property, hoping to close that by year-end or early January. And then there's the really challenging solar property in San Diego.
That one's been stuck for a while, right?
For 4 years. It's been stuck in, bureaucratic quicksand, difficulties getting a lot split, meeting new ADA standards. It's now expected to go to market in Q1 2026.
So we have these clear steps to eliminate friction and recycle capital. Did they signal any relief on the expense side of things?
They did. Management expects property operating expenses should decline by roughly $100,000 in 2026.
Okay, so another little boost to the bottom line.
It's from certain legacy costs, rolling off and recycling some of their older non-triple net assets. So, yeah, another layer of AFFO acceleration next year.
This gives us a really complete picture of the internal plan. Let's pivot now to the investor context. Modiv pays a monthly dividend that works out to about an 8.1% annualized yield. That's high.
It's very high. And that high yield is the risk premium the market is demanding. It's for their small size, limited liquidity, and a pretty high 81% AFFO payout ratio.
So the market is saying, we have some fears here.
Exactly. Compared to the broader REIT benchmark, which yields closer to 4%, that gap shows the market's concern about their ability to execute or just endure this rate cycle.
But management seems to be actively positioning for an easing cycle. How does that play into their capital allocation right now?
It's the core of their entire capital debate. They're refusing to use expensive external capital, period. They're very cautious about issuing perpetual preferred stock at around 8%, which some other small REITs have done.
They'd rather wait.
Their view is strategic. They believe if they just wait until the Fed starts easing, likely in 2026, they'll be able to access cheaper common equity. So they're choosing to grind it out internally with asset recycling until the market improves.
So patience over speed, long-term thinking.
It is. And the sell side seems to view this durability favorably. The average brokerage recommendation before the call was outperform, with a price target around $17.75.
Which implies a lot of upside. It suggests the fundamentals are there, but the price is lagging because the market needs to see catalysts.
The management basically laid out a roadmap. First, close a deal on that Costco property and stop the bleeding. Second, Prove the recycling strategy works by closing some of those seven-handle acquisitions. And third, the big one, get a broader tailwind from Fed rate cuts.
And this is where it gets really interesting. It's time for our segment. This is not financial advice, where we synthesize all this into a strategic trade idea.
Right. Given the balance sheet durability, the high yield, and these very clear, quantifiable internal catalysts.
Especially that $40,000 a month drag removal.
Exactly. We see a classic opportunity here to bet on micro-level execution.
Okay, what's the pitch?
The idea is a strategically paired long-short trade. You go long Modiv Industrial, so MDV, against a simultaneous short position in a large, liquid, lower-yielding REIT ETF, something like VNQ.
I like that. So you're isolating the company's specific path to success while hedging out the broader market risk. Walk us through the rationale.
The core of it is betting that Modiv's idiosyncratic catalysts will get resolved. The asset recycling spread and the removal of that operational bleed should provide immediate, quantifiable AFFO growth that is specific to Modiv. That should drive out performance.
And the short ETF position.
The short VNQ is your hedge. It protects you against continued overall REIT market pressure from interest rates. The goal is simple. Capture alpha from the cockroach story while managing your biggest external risk.
That's a highly disciplined way to play this particular name. So to wrap this all up, what's the final takeaway?
The core takeaway from this deep dive is that Modiv delivered a strong AFFO beat. It was driven by cost control and balance sheet integrity. They are fundamentally sound, and they've engineered this very disciplined plan to generate internal growth while they just patiently wait out this volatile rate cycle.
It's a bet on durability over speed, positioning the company as a survivor that's ready for the next growth cycle. So the provocative question for you to consider is this. If that asset recycling plan executes as outlined, and the Fed does start easing in 2026...
How quickly could that happen?
How quickly might the market compress Modiv's persistently high 8% yield to align it with its larger, more liquid industrial peers?
If that risk premium evaporates, the yield compression could generate some pretty explosive capital appreciation.
An excellent synthesis. Thank you for joining us for this Talk Tickers deep dive. We encourage you to continue exploring the material and, as always, form your own conclusions.